Coming up on the SBS On the Money podcast, oil prices surged to a 4-month high. It means petrol prices are likely to rise. We'll take a look at the implications for interest rates and inflation. All that next. Hi everyone, it is Friday the 13th of June 2025 on a day where the Australian share market fell by 0.2% to 8,547, and it comes amid those rising tensions in the Middle East. Petrol prices could rise by at least 10 cents per litre over the next coming period as a result of increased tensions, as attacks on Iran has seen oil prices spike 10% overnight, lifting energy and gold stocks today on the Australian share market, but not the other sectors. The ASX 200 down 0.2%. The main story, of course, oil. Brent crude, for example, surging overnight 10% to levels not seen since February at about $78 a barrel. And while it has been higher in the past, what's surprising investors is the speed at which the price has risen, up almost 20% since the start of the month. That's bound to have implications for motorists. So to tell us more, I spoke with AMP Chief Economist Shane Oliver.
It certainly does look like it's out of the blue, but I guess the oil market was sniffing around on this issue because there had been in the last few days some warning signs out there that Israel was contemplating this attack on Iran. There had been some warnings by the UK Navy to sort of stay away from the area. So earlier this month, we were around $61 a barrel US for the world oil price. It had crept up to around $68 a barrel. And then, of course, on the back of this news of the attacks, it sort of spiked to around $74, $76 a barrel. So it certainly looks like a spike, looks like it's out of the blue, but oil prices had been creeping up over the last couple of weeks.
What are the implications on the oil price of this conflict, do you think? And can you also still put it in the context of, yes, we've seen a huge increase in the oil price in the past couple of days, right? But we're still below where the oil price was this time last year, right?
Yeah, we need to put this in context. Yes, we've seen a huge spike, but all that's really happened here is that oil prices have gone back to some of the levels seen last year. In fact, we're still slightly below where we got to last year on the back of similar missile exchanges between Iran and the US and Israel. So in the great scheme of things, you could argue, well, it's just been in the range it's been in for some time now, so you shouldn't read too much into it. But obviously when these things happen, the oil market gets skittish and it gets worried that the tension will overflow, that Iran will retaliate, not only by attacking Israel, but more importantly, by disrupting the flow of oil from the Middle East. Just bear in mind that about 20% of world oil supply, world oil consumption, flows through the Strait of Hormuz on a daily basis. And it's quite conceivable that Iran could disrupt that if it gets annoyed about these attacks. So that's the risk in all of this, and that's what the oil market is trying to factor in here. Of course, like last year, it could all settle down again and come to nothing. But of course, the traders in the oil market don't know that, and so they're trying to work out what are the risks around this, and that's why we're seeing the spike.
All things or all other things being equal, right? At this stage, what does it mean for petrol prices?
Well, for petrol prices, the spike in oil prices that we've seen so far this month, particularly in the last day or so, means about a 12-cent a litre increase in Australian petrol prices. Now, of course, it's going to vary from where you are in the country. Different states, different cities, different spots in the weekly, monthly discounting cycle. So it won't necessarily flow through straight away. But if oil prices stay around these sorts of levels, on average, you'll see about a 12-cent a litre addition to petrol prices over the course of the next 2 weeks or so.
What does history tell you about what happens with these types of conflicts? I mean, is there the potential for oil prices to still climb even further?
Well, the oil conflicts that we saw in the 1970s, particularly with the Arab-Israeli conflict of 1973, saw oil prices go up something like 4 or 5 times. And a similar story with the Iranian Revolution in the late 1970s. So they're the worst case scenarios. And when you get an increase like that, oil prices going up by multiples of their starting point level, then you get a huge flow on to inflation, just like we saw in the 70s and 80s. More recently, though, the oil price rises have been a lot more contained. Think about the Gulf Wars that we saw in the 90s. The impact was a lot more short-lived, and of course in recent decades it's been relatively minor. But central banks tend to look through it. If we do see a spike in petrol prices, the Reserve Bank will most likely say, well, this is not something we can control. We can't control what happens to the world oil price, so they'd probably look through it as being a temporary thing. And I think most central banks would see it that way. So that's why the money market today has actually increased slightly the probability of a rate cut in July. It's gone up from around 84% chance earlier this morning to now around 87% chance. So the money market is sort of taking the view that the Reserve Bank would see this as a tax on consumer spending rather than a further addition to inflation.
That's Shane Oliver there from AMP. That's the podcast for the week. Don't forget, if you enjoy it, to give a rating or a review on Apple Podcasts and Spotify. And this SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.